Okay, I think, yeah, that's a 7. Okay. Oh, hi, I'm just playing some Sudoku, which actually is the segue into today's video where we're looking at Embracer Group, and I'll explain why I'm playing Sudoku. And before we look into Embracer Group more and all the games that they have, I just want to have a quick shout out to Oscar100% on Twitter, who brought this idea to my attention. There's actually plenty of people on Twitter who brought this idea to my attention, and they're a serial acquirer, and I like serial acquirers. So Embracer are a Swedish-based gaming serial acquirer company. So they've been issuing a lot of shares, and that's probably what has turned me off in the past, was just looking at that share count get insanely crazy. Like it's gone up like 20, 30% per year for the last few years. And I just don't normally like when serial acquirers are issuing so much stock, but there's I've been explained a bit of a reason to that, and that's why I'm digging into this a little bit further today. So as you can see here on the screen, all the IP that Embracer have acquired. So some pretty impressive names there. A lot of their IP and a lot of the gaming studios and things like that you probably have never heard of. They're pretty obscure little companies, or obscure little games or brands. But as now a gigantic diversified gaming developer and producer, this diversification makes it really interesting, because they can, instead of just imagine being a one studio with like 4 or 5, maybe 10 developers, and you hit a really successful game in one of the games that you've been building, and that goes really successful. Your studio is tied to that game essentially, and it's really difficult because it's such a hit and miss kind of world in the gaming space. It's so hard to have reliability for a studio, and studios go in and out of business all the time, because they're kind of like one-hit wonders a lot of the time, or they have issues with the smoothing out of the crazy volatility that goes on in the space. So let's say they had a game, and the first one they had was a complete success, and they get all this money come in, and it's amazing, and they start developing on like the second installment of the game, for example, and then that's a flop. And they've hired all these people to develop the second game to make it even better, but it was a flop, so then they have to retrench all these people because they didn't get the money. Anyway, it's a bit of a minefield, and I would say it's actually not a good business. It's a creative business. It's difficult to predict what's going to happen. But what Embracer have done is, by conglomerating them all together and working them together as like this gigantic kind of team across all these different spaces, it's given them a huge advantage to level that volatility, so they can have massive winners and flops, and it allows the creators and the developers the breathing space that they're not going to lose their jobs, and they can actually really focus down on developing amazing quality content. So I really like that competitive advantage. It's why but there's a lot of competition in this space. We've got like Activision Blizzard, EA Games, Take-Two, Nintendo, Tencent, like Ubisoft. There is just Ubisoft. Sorry, I don't know why I said Ubisoft. Ubisoft. There is just huge competition in this space, and then by gigantic conglomerate companies as well, with huge amounts of brands and stuff like that too. So it's not the only case of this happening. So there's plenty of competition. The way that they're approaching it is from like the serial acquirer's perspective, and I think that's really interesting, and that's why. There you go. There's a bit of a summary. We're going to dive a little bit deeper now. So they have 12 subsidiary companies with, I think, 134 studios underneath all of that in total now. It actually reminds me a lot of Constellation Software, where they've kind of put 12, Constellation Software have 8 or 9, I think, but what Embracer have done is they've kind of like siloed out the business into separate sections and then put studios underneath them, so then they can be self-managed, and they explain how decentralized it is, which is a bit of a buzzword in the serial acquirers world, but that's how it should work, because Constellation Software, all the good serial acquirers have worked out a way to decentralize operations so that the people who are closest to the customer can make decisions, and they're the best people in to grow the businesses that they own, that they run. And that seems to be working so far for Embracer, and we'll get into some numbers soon. Okay, now let me be honest. I think the reason why I'm digging into this company is because of the CEO, Lars Wingefors. I maybe mispronouncing. But he, I think, is like an outsider from the book The Outsiders. I think he's got a really good attitude on and perspective on how he's going to grow Embracer Group. And that's got me intrigued, and that's why I'm digging into this. Otherwise, I probably would have been a bit hesitant just with all that, the share issuance and the competitive nature of the space that they're in, but Lars has kind of got me hooked. And this story has been told plenty of times. I will quickly summarize it. Lars, as a teenager, sold mail order comic books, used comic books from his house, and turned that into selling secondhand video games all through mail order back, 30 years ago. And it became very successful and cashed out for a multi-million-dollar sale and exit. I'm pretty sure he was only 15 years old. So he dropped out of school, focused down on his growing these businesses, and he ended up losing most of it, rebuying back the company in his early 20s, and then building it into what Embracer is today. So it's a pretty wild story. And this is his life. Like, he's not someone from a different industry that's come in and saw an opportunity for acquiring businesses in this space. He is a gaming guy to his core, and the way he speaks, you can pick that up in everything he ever says. Now, based on everything I've read about Lars, I think he is got a really great long-term mindset. I like that he's decentralized the operations of the business, just like Constellation Software has done. I think he has strong alignment with shareholders, with about 20% of the shares outstanding in his name. So, and he has over 50% voting control of the company as well. So this is an owner-operator running this business, and since its market cap is around $6, maybe $7 billion, depending when you're watching this, and depending on the exchange rate a little bit. But he's a billionaire in his own right, and he said multiple times, "I've made my money. This is not about the money. I'm trying to do this the right way and do this for the long term and build this into the greatest gaming empire that he could possibly can." So. I really like that the subsidiaries themselves talk really highly of Lars as well. They sing a lot of his praises. Take that with a grain of salt, I guess, for people talking about their boss like that. But I think he's cracked a bit of a code in the gaming space that is helping the developers really just not have time pressures on getting a game out on a certain deadline. If the quality isn't there, they push the deadline, and he's happy to do that. And I think that's a big difference to EA and Activision Blizzard, where it's a bit more of a pressure cooker situation to get games out on time, and I think that can make more misses than hits. And Embracer, I think, understand gaming more than the others. That's my gut feel. So I think it's really important to get your head around the hit and miss nature of this business and how Embracer have been able to level this out a little bit. So on the screen here, as you can, what's going on here is on the left-hand x-axis, we've got the quarters since the game was released, right? So after 5 quarters, after 10 quarters, 15 quarters, so on, along the bottom here. So as time goes along, the y-axis is showing the ROI of the project. So these are all the different projects that they've been involved in, and this is in the PC console space, and you can see that it is very asymmetric. Some of the releases are pretty poor. One times ROI would be break even, and some of them don't break even. They're money losing games, but for those types of things that happen, you get the occasional 100x ROI, and some of these well above the 10x ROI some of them within, say, looks like 2 years of release. So the asymmetry of when a blockbuster game can be huge, and it turns out that, as you can sort of explain, this graph is explaining, I think, really well, that the average return on investment is 2.44 times on a game. So they've been able to balance it out with all the diversification, and I think that is giving them this big advantage and opportunity to keep this business sustainable. Now with hit and miss games, you can get a little bit of hate because Saints Row, for example, is a game that came out just recently, and it was a flop essentially. This is like Saints Row was a big hit game, and then the second or whatever version they're up to in the game got released. They spent a lot of money on this, and it just hasn't seemed to go down that well. And there's a lot of criticism online about how they kind of ruined it. Blah blah blah. There's a lot of hate. It's because the gaming industry is super fickle, and that's just the deal. And you've got to get your head around gaming as a industry and understand the ups and downs. But that slide that I showed you just before, I think highlights it beautifully, where the asymmetry of a game is worth the effort, and having the diversification means that you get the benefits. And there is a really good structure of a business here where you do get reasonably good ROIs on average. Okay, now let's talk about that stock dilution. And I think this is really important because I'll be honest, this is the thing that is bothering me the most and always has bothered me the most, is the aggressive stock dilution. Let me try to explain it like this. Let's say your business, which Embracer has been valued at crazy multiples in the past, 15, 20, even 50 times EBIT, right? Their own company. So if you can issue shares at those valuations, yet then go and buy businesses at 5, 6, 7, even 10 times EBIT, you're arbitraging your own stock price to go buy accretive valuation businesses. To essentially, you're exchanging your shares for at a better deal. It's an arbitrage. So now that the stock price has actually come down really dramatically, just like a lot of growth companies in the pandemic boom went crazy. You've seen these types of stock charts before. They're in most of the tech companies. It's come back down very significantly. So EBIT at the moment for Embracer is somewhere between 8 and 10 times. So the arbitrage is gone. This is what I really need to see from Embracer. I really want to see what happens with their acquisitions over the next 12 months. Because if they're issuing a lot of stock, even at this valuation, and buying things for a similar valuation, I don't think that is a good use of stock dilution. I don't think that's good use of their of that strategy. I think they now need to go down the debt path, but debt may be getting a bit expensive too. What I really want to see is them utilizing their cash flow to make the acquisitions. So that's what I need to see, because I think that is the right thing to do anyway, is using the cash flow to propel the business forward. So slow down on the acquisitions, Embracer. If they can do that, I will think that management have really understood their capital allocation side of the business. And I still need a little bit of proof in that, because all we've seen for the last few years is aggressive acquisitions by leveraging their stock price to issue stock. But now I want to see, just like Teledyne had done in the past. Teledyne's a company back a long time ago now, 40, 50 years ago, that was with Henry Singleton, was issuing stock like crazy to make acquisitions when the stock price was really high and overvalued. But then when it pulled back, he was doing the exact opposite. He was buying back shares. He was slowing down on the acquisitions, focusing on organic growth. They're the things that I now need to see Embracer doing. So just get a feel for that growth that they've been experiencing. Here is the P&L, and just the year-on-year growth in net sales is more than doubled, 128%. But the organic growth is actually a little bit down. That's gaming industry wide. I think -3% organic growth is actually not that bad, considering what it could have been. I thought it would have plummeted, but it's nearly flat, which I think is pretty good. So all of this this growth is attributed to acquisitions. The EBIT in a similar way, they adjusted. You have to get your head around the adjusted numbers, but I've actually gone through it. I'm pretty happy with how they made the adjustments. Big growth in the EBIT as well. So that's why when you look at this company, you've got to look at a per share metrics. So earnings per share, free cash flow per share, book value per share, all those types of things. It's got to be on a per share basis, because the dilution has been crazy. So we've got to look at the per share. So this is the most recent report, and the per share, adjusted earnings per share has actually gone down 21% from year on year. So the stock price is getting punished because the growth is declining. And we can see that here in the next slide when we look at the financial development. The gross margins have started to decline over the last year and a half. We're at 56% now. Even though net sales has been going crazy, the margin has been declining. And this is what sent the stock price plummeting. And now we've got like operating expenses rising, obviously, with all those acquisitions. But as a percentage of net sales, it's probably flat. Adjusted EBIT, so that has grown, but it's actually down a little bit on the previous quarter. But as you can see, the acquisitions make that EBIT been rising over time, but the margins are coming down. Now we got the next slide is talking about their free cash flow. And that has grown, but again, this is acquisition based, so we wanted free cash flow per share we have to figure out. I think the forecast is really interesting. They've actually they made these forecasts to where they think they're going to be in the next year or two. So financial year 22-23, which we're in right now, EBIT somewhere between 8 and 10 billion SEK. And they're looking, I think they're going to be on the low end of that. I reckon it's going to be somewhere around the 8 number by the looks of things, but because it's come back a little bit, their EBIT. I think if they can hit even 10 billion for financial year 23-24, so 1 year's time, that's still a 20% growth in their business. So that's the low end. That would actually be under their forecast if they hit only 10 billion. So I'm going to assume at the moment that they can figure out a way to grow at around about 20%. They have a lot of new releases coming out in the next 12 to 18 months. Lots of new games, lots of things in the pipeline. They're going to still make some more acquisitions. I just want to see how they're going to make those acquisitions. Please read the presentation and listen to Lars speak about all of this stuff, because it'll get you a feel of this is, if anything, it was nearly expected that they'd be a little bit flat, if not down for the period at the moment. Next quarter probably similar, but it sort of ramps up with the new releases of all these games. You just got to hit some winners with those games, though. That'll be the key. So on the screen, I've actually attempted to do some sort of valuation here, and it's a little bit tricky, but I've had to use this model that I have on the screen here, which I'll explain, because I needed to factor in a dilution rate. So we've got current revenue, and I think their revenue growth rate, it has been growing at like hundreds of percent over the last few years, but I'm going to say that comes right back down to 20% revenue growth rate. So that's including organic growth and inorganic growth. I think 20% is really conservative. They've been, I would say that there is a high likelihood that organic growth maybe stays flat, if not single digit growth, but then acquisition bolt-ons, if they can buy them at 5-6 times, well, that could be the 20% growth as well. So it could easily be 25-30% growth, but I don't want to go those big numbers, because I'm hoping that they actually solidify their business, and while their valuation, it is what it is. And anyway, let's just do 20%. The free cash flow margin is roughly what the business is turning their revenue into free cash flow, which is really strong. I think if a business growing at that with those margins could easily get a free cash flow multiple of 20. I think that's very fair. The dilution rate. Now, I'm hoping that it slows down a little bit, but I'm not saying it stops completely. 10% is still very high. I think it could very easily be, if they go down the Teledyne approach, this could be 0, and I will show you what that could look like. But that shares outstanding number, I'm assuming, based on what they've done in the past, could continue to rise. So we're looking at, with the current market cap, I'm looking at a 5-year compound annual growth rate of around 24% at these numbers. I think this is probably around about fair. The thing is that growth rate is really hard to figure out, and the dilution rate is hard to figure out, hence why I'm wanting to wait. But let me show you another variation of this, like the upside variation. So what I've done in the next valuation here is gone a little bit more optimistic and said that the revenue growth rate actually can be higher than the 20%, just 25%. Could easily be 50%, but let's just temper expectations here. A little bit of an increase in the multiple based on that higher growth rate, but the dilution rate comes down. So instead of the dilution rate being 10%, I'm saying it's just going to be a little bit of dilution through some of the stock-based incentives and things like that. But they're essentially not using stock now to make the acquisition. So I've said it could be possibly 3%, which I think would cover the stock-based comp and incentives that they've made in the past. So now we're talking, based on the valuation, based on the price that it is today, we're looking at like 43% compound annual growth rate, which is insane. Hence why I think this is very interesting, because it could easily be a huge winner. But I could be wrong, and let's just assume that the stock dilution doesn't happen. The stock dilution does happen at the same speeds as it has been happening. I'll show you what that looks like now. So because of that stock dilution, when the revenue growth rates and let's say the multiple is back down at 20, but the dilution rate I've put up to 20%, we're looking at a compounding growth rate of 18% per annum still, which is very strong. So look, I think the prices may be very attractive, and there's still some questions to be answered, and let me summarize everything now. Okay, there's been a lot of price pressure on the stock, and I think it's due to the recent big miss with Saints Row. Couple that with just the growth market, the growth stocks generally worldwide just getting absolutely punished, rightfully so. I think there was a lot of overvaluation going on. I think the flop of Saints Row is very short-term thinking. They have so many, it's one of just hundreds of games that they have, but yeah, I think it's short-term mindset thinking, and I think that coupled with all the stock dilution, people have been losing faith in the leadership team. So that's something that that's why I think this opportunity exists. If we look at the last few years, their earnings per share has grown at about 45% per annum. That's a pretty cool earnings per share growth rate. And that means if it's 10 billion SEK next year, right now you're paying a 6 times EBIT for this business. Just 6 times. That's not far off what you'd get for a private business, let alone this is a diversified public company with, I think, very highly incentivized leadership. Getting it at next year's paying 6 times EBIT for just next year's number. It's about 8 times right now. That's cheap. That is, however you look at it, it's cheap. But I don't want this to be a value trap because of that stock dilution and stuff like that. So yeah, have to be cautious. So what I'm looking out for is I'm just looking out to see over the next 6 to 12 months what they do with that stock dilution, what they do with their acquisitions, and how they allocate the capital essentially, and how they make these decisions. That's the key element here for me. And if we look at it just like their free cash flow, you're paying about 9 times free cash flow right now for a business that has been growing like crazy, diluting like crazy as well. So I guess it's hard to get a bit of a read there, but like it's cheap, like it really is. So for me, this is one I'm closely watching. This is going on my watch list. I'm going to see what happens over the next few quarters. I just want to see the change in direction from Lars and what they do here when they have their stock price themselves lower. That arbitrage now doesn't exist. I want to see the direction they take. That's going to be really interesting. All right, so I've talked a lot about Embracer today. I hope you've enjoyed it. Please go and study Lars. He's an exceptional CEO, very interesting guy. I hope you've enjoyed, and I'll see you in the next video.